Welcome to vTalkInsight, Market Drivers Daily, for June 23, 2026. Today, the AI Capex boom is colliding with a tech-led sell-off and a fresh twist in U.S. Iran oil policy, forcing a rethink of how sustainable this equity cycle really is. Let us start with the AI trend, where massive investment, rising costs, and early regulation are reshaping both upside potential and downside risk. AI is still the dominant driver of equity narratives, but the story is shifting from pure enthusiasm to a more complicated phase of heavy capex, rising costs, and growing policy risk. Recent sessions showed that when the AI trade wobbles, it reverberates across indices, credit, foreign exchange, and even commodity markets. The key question now is whether the current investment surge will translate into durable cash flows, or whether we are setting up for an overbuild and sharper repricing later on. The scale of this cycle is already enormous. AI infrastructure spending has tripled in 2 years to around $750 billion, roughly 2.5% of U.S. GDP, and some forecasts see cumulative investment reaching several trillion by decade end. Leading tech platforms are accelerating data center and chip-related capex, with 2024 outlays projected to be about 80% higher than last year, and some of that is now being funded with debt or fresh equity rather than internal cash flow. Government policy is amplifying the trend, from U.S. support for AI and semiconductors to a $500 million CHIPS Act award for Sandbox AQ and equity stakes in quantum computing firms that aim to secure long-term technological leadership. Market performance has become increasingly tied to this theme. AI and energy together account for most of the equity gains this year, while the broader market would be negative without them, illustrating how narrow leadership has become. Flows into AI and tech exchange-traded funds are so strong that they are starting to strain replication, with underlying shares in names like NVIDIA, Microsoft, and Meta in high demand as compute capacity lags AI infrastructure needs. At the same time, a handful of firms dominate AI revenues and token usage, which creates concentration risk if spending by large clients slows or if new regulation reshapes business models. The risk side of the ledger is becoming clearer. History around fiber build-outs shows that even transformative technologies can deliver poor returns for early infrastructure investors if capacity overshoots demand. Today, token and cloud costs are rising faster than most IT budgets, which are growing only modestly. And major corporates such as Walmart, Uber, AT&T, and others are starting to cap AI, spending, or demand price cuts. That is feeding into concerns that AI compute could become commoditized over time, with global competitors pressuring margins just as many projects shift from cash-funded to debt-financed, increasing sensitivity to the rate cycle and credit spreads. There is, however, a robust countercase that this is still early in a long productivity cycle. Some enterprises report tangible gains, such as about 20% efficiency improvements for software developers, and AI-driven coding alone accounts for a large share of current usage. Physics-based AI is opening new frontiers, from NVIDIA and Sandbox AQ using models to compress drug discovery timelines, to applications in material science, batteries, catalysts, and environmental cleanup supported by public funding. Agentic AI, where automated digital agents handle complex tasks, is expected to unlock further efficiency across industries, while Gulf sovereign funds and U.S. policy support continue to direct substantial capital into the AI ecosystem, from chips to utilities powering data centers. Policy and macro linkages are also tightening. Regulators are increasingly focused on AI safety, data quality, and potential access to classified systems, raising the risk of intervention, delays to product releases, or even government stakes in leading platforms. Internationally, the UK is trying to position itself as a hub for advanced AI while worrying about dependence on foreign hyperscalers, and the weak Japanese yen is partly framed in the context of strong dollar demand linked to U.S. AI assets. For portfolios, this all means AI remains a powerful secular tailwind, but one that now comes with higher volatility, more explicit concentration risk, and a growing search for hedges, including negative beta equities and exposures in adjacent sectors like utilities and infrastructure. As we turn to geopolitics, that search for balance intersects directly with how energy and Middle East policy are evolving. On the geopolitical side, U.S. policy toward Iran has shifted again, with new waivers allowing Tehran to sell oil in dollars for 60 days and move previously blocked cargoes through the Strait of Hormuz. Roughly 30 million barrels have already headed toward Asia under this framework, and U.S. refiners are now legally able to buy Iranian crude until the end of August, even if European constraints keep some buyers cautious. This is helping to pressure Brent and WTI, which have slipped back toward the mid to high 70s, easing some inflation and rate concerns compared with the war-driven highs we discussed last week. However, much of the recent surge in Iranian exports reflects a backlog of previously trapped barrels finally moving, and flows through Hormuz remain well below normal, with only a fraction of typical daily vessel traffic. Global stockpiles are already depleted, with several million barrels per day effectively missing from the market, and key infrastructure like Ras Al Khaimah will take years to fully repair. That combination means the current soft patch in prices may be fragile, and several scenarios now on the table include a rapid spike from around $75 to well above $100 if supply constraints persist and inventories are not rebuilt. Security around the strait remains a critical swing factor. Merchant transits have recovered from the lows of only a handful per day to around 30. But that is still far from the pre-conflict norm, and hundreds of ships and thousands of seafarers are yet to be fully evacuated. Temporary traffic separation and coordinated routes through Omani waters improve safety, but mine risks and unresolved questions about potential tolls or control keep tension high, even as the International Maritime Organization pushes back against unilateral fees. Gulf states worry that a better-funded Iran, armed with new oil revenue and access to previously frozen assets, could translate financial gains into regional influence and defense spending, even as Qatar and others appear to be political winners from the current U.S. tilt. For macro and markets, the picture is nuanced. In the near term, additional Iranian barrels and optimism around talks support a disinflation narrative and even a more dovish tone from the European Central Bank, which could benefit European sovereign debt. Yet oil still trades at a premium to pre-conflict levels, and traders have been reluctant to go structurally long because each political headline has delivered abrupt downside, discouraging speculative positioning just as physical balances stay tight. That leaves a gap between spot prices, which reflect optimism and tech-driven focus, and the underlying risk that a setback in negotiations, shipping accidents, or slow demoning could quickly reprice crude, with knock-on effects for inflation, rates, and energy-exposed equities. Against that backdrop, the most immediate market stress is not in oil, but in technology, where selling pressure has intensified. The equity tape today is being driven less by oil and more by a sharp, tech-led drawdown that has spread from Asia to Europe and back into U.S. futures. In Korea, the Kospi has dropped around 10 to 12% in recent sessions, triggering circuit breakers, with memory names such as SK Hynix and Samsung falling close to 13% at one point. European tech, including ASML and ST Micro, is following lower, and Nasdaq futures are down more than 2%, signaling another risk-off open for U.S. growth stocks. The core narrative behind this selling is rising doubt about the straight-line AI demand story that had powered semiconductors and high-multiple software. Reports of SK Hynix shifting capacity back toward commodity D are AM and away from premium AI memory, along with talk of potential production cuts, have raised questions about the durability of hyperscaler spending. At the same time, global chipmakers from Micron to their European peers are under pressure, and some AI-focused exchange-traded funds are struggling with replication as they navigate heavy redemptions on the back of crowded positioning. On the customer side, there are growing signs of cost pushback. Large corporates are pushing back on AI pricing, capping token budgets, and reassessing the profitability of high-end deployments, while there are early signs of demand destruction in premium consumer hardware as prices bite. This sits alongside warnings that AI infrastructure Capex could lead to overcapacity, and that rising reliance on borrowing and private credit to fund projects will change return profiles in the next phase of the innovation cycle. After a strong run, that combination is feeding profit-taking and valuation fatigue, particularly in long-duration names whose cash flows sit far out in the future. There are still important counterpoints. Some firms with credible AI strategies and improving financial metrics, such as those showing accelerating growth and operating leverage, continue to outperform, and earnings revisions for select AI beneficiaries remain positive. Strategists at major banks remain broadly constructive on the S&P 500 over the medium term, though they emphasize that further upside now hinges on clearer evidence that AI Capex is translating into earnings, especially as central bank support fades. Near term, attention is fixed on catalysts such as Micron's results, which could reset expectations for memory shortages beyond AI, and on the timing and valuations of potential IPOs in AI and quantum that are watching current tech multiples closely. From a portfolio perspective, this episode underscores how concentrated the equity rally has become, with institutional allocations to tech having nearly tripled benchmark weights since the onset of the Iran conflict. When that kind of crowded trade comes under pressure, the spillovers can be fast, with leveraged retail exposure in Asian AI names adding to downside momentum and private credit funds seeing elevated redemptions linked to software and AI anxiety. As a result, many investors are reassessing their toolkit, exploring equity-based hedges with negative beta characteristics across sectors such as energy, consumer, utilities, and parts of financials, while also revisiting opportunities in areas like defense, biotech, and municipal bonds that are less tethered to the AI cycle. Bringing it all together, the intersection of an AI-driven Capex boom, shifting Middle East risk, and a tech-led drawdown is setting the tone for cross-asset markets this week. To wrap up, the AI theme still underpins equity indices, but the conversation has moved from pure upside to a more balanced focus on cost discipline, financing risk, and policy intervention. Geopolitics are temporarily easing inflation pressure via Iranian oil flows. Yet tight inventories and fragile security around the Strait of Hormuz keep the risk of an energy shock very much alive. Meanwhile, a global tech sell-off centered on chips and Korean equities is stress-testing crowded AI exposures and forcing a broader rethink of concentration and hedging across portfolios. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.